When we talked about this conference, I got given a title for the conference that was the interoperability of the GRI, ISSB, and ESRS standards. And I thought that'll really draw an audience, you know? So what we said is, let's change that around. Let's ask the question, do you know anything about these standards? And do you have any insight as to whether your advocation for what types of standards we go for, what that impact is going to be in Africa if we get it wrong and if we get it right? So we're on a journey today. We're not even halfway through this journey. But this is a conversation we have to have right now, because this thing is moving so fast. And I really, really want to thank two very important sets of people. One, I want to thank SECO, and you're going to hear from Daniel in just a second. And I want to thank the GRI. And what role do these two actors play in this scene? They really made this forum available for us all to participate in. They really helped fund it, promote the idea, and in spite of the fact that you see a few seats here and there, we've got a huge audience behind us waiting to hear what we have to say. This is to be an interactive discussion. Nobody really knows what we're doing in this space. We're all stumbling along. But let's hear from Daniel as to, I'm going to now pronounce his entire name, Daniel Loschenaar. Thank you, from SECO.
On behalf of the Embassy of Switzerland and the State Secretariat for Economic Affairs, SECO, I would like to welcome you also. It's a big pleasure to be here, and it's a super important topic we are talking today. Switzerland, and that alludes to the role we are playing, is giving the topic of sustainability reporting big attention, and we have been financially supporting the GRI since many years. SECO is implementing Switzerland's Economic Development Cooperation, part of Switzerland's ODA, with, as the name says, Economic Development Cooperation, a strong focus on economy. Hence, the sustainability reporting playing an important role. We have also other programs in that field. We work with the International Finance Corporation on ESG standards. In South Africa, we are focusing on pension fund. In other countries on different topics. But it has been an integral part of our cooperation since many years. But you know it, and that's why you're here. There's been a lot of traction in the system. New standards, different standards are emerging. There's also a move from voluntary standards to compliance, or the European compliance, and reporting compliance necessities has been largely discussed. How is this all linking to each other? We believe there is momentum, and it's really important to have this discussion today. Which standards? How do they link? How do they compete potentially? And I'm really looking forward to this discussion. Investing in sustainability performance and reporting is good for business. It helps to drive business towards greater purpose and better engagement with stakeholders. There's a business case also in it. You see it when you walk in supermarkets. Voluntary standards are everywhere. Sometimes overwhelming. Which one is really trustworthy, which one not? So I really think it's a good opportunity today to have this discussion. I will be super brief. I don't want to take your time. The experts shall talk and discuss, and you should have the opportunity to engage and ask questions and discuss. So I'll leave it with that. Thank you very much for being here. I'm looking forward to exchanging. Thank you.
Welcome to GIBS. And please get us going here. Set the scene.
Thank you very much, and greetings from remarkably sunny Brussels over here. And before I start, I would like to say my sincere thanks to Daniel Lachenmauer from SECO, and of course, University of Pretoria, Cabot-Alletzhauser. And thank you for giving us the opportunity to speak on this wonderful event. Well, let me start with reiterating what the previous speaker said when it comes to speed and the importance of standard and standardization in the field of sustainability and sustainability reporting. There are a couple of things that we must understand that are of extreme importance before we even go in the details of standards and in the details of the global developments around standard setting. And that is the why do we do this? What is the objective? Well, of course, all of us, we want to see a more inclusive, a more healthy, and a more prosperous world for all of us. And we all need to contribute to that. That is governments, regulators, businesses, but also society as a whole. Because we can only achieve this if we are able, indeed, to transform global supply and value chains. And the roles we have as standard setters is contributing to this, to enable businesses and other organizations to report on their endeavors on important topics like the Sustainable Development Goals that are also covered with our standards in a comparable way. In a comparable way, more hopefully than not in a global comprehensive baseline, so that data is manageable and comparable for investors and also society, the other stakeholders. It is important that we enable society to make decisions based on comparable facts and not on perceptions. It is important that we all on a global scale know how to work and to operate with this information. And we can only do that if we have a simple, easy to comply system at low costs. And that is what GRI and also ESRS are really pushing for. The importance for understandable, low cost, easy to comply standards on a global and with ESRS European scale. But it takes, as they say, two to tango. When it comes to sustainability reporting and the drive towards a global comprehensive baseline, it needs thousands to tango, so to speak. Why? Because the sustainability report by itself is the result of a myriad of transactions in the value and supply chain before even data of the reporting entity can be extracted and put into the format of the standard. What do we mean by that? Looking at scope 3 information, for example, of clients, of suppliers, but also social topics on human rights, child labor, indigenous people, diversity, equal pay, right to organize, or anti-money laundering, anti-bribery and corruption. And if we go back to the more classical, well-known topics for many organizations, climate-related, water pollution. These topics contain sets of information that the reporting entity by itself cannot capture. It needs to acquire information from a myriad of players, their suppliers, their employees, the local communities they operate in, and last but not least, the small, medium enterprises that are of extreme importance for global GDP, for local economies. More than 80% on average is being floated by initiatives of local small and medium enterprises. We should not forget to take them on board as providers of services and information needed to report on. Without onboarding small or medium enterprises around the globe, the information to be provided will have less value. So what is GRI's role? As you may have seen, we are an integrated part of the European Sustainability Reporting Standards. We are, as we say, embedded within this European framework. And as you may have seen or perhaps heard of in our joint statement with EFRAG, the European Financial Reporting Advisory Group, responsible for the rollout of the European Sustainability Reporting Standards, we have announced a high level of interoperability between the GRI standards and the impact side of the European mandatory standards. Why is this important to know? Well, if you are a GRI reporter, you are more than well prepared for the European Sustainability Reporting Standards. If not, just have a look at those that do, and you know what the future will hold for you. Besides, there are more than 11,000 organizations using our standards that form a wonderful benchmark, but also a source of information, because we know that if you engage with organizations out of your industry that already went that way, they're more than happy to explain what their journey complied of. Going forward, we see a tremendous uptake in thinking on impacts as something of extreme importance when it comes to reporting on sustainability-related topics, besides the financial effects of the reporting entity itself. Politically, it's very difficult nowadays to sell that sustainability and general welfare for the planet is something of interest to investors in the reporting entity only, and something that is only relevant to the bottom line of the reporting entity. It is a myth that investors would only be interested in that part. And of course, it's also a myth that organizations that are not profitable and do not yield a certain return on investment to investors would be beneficial to the transformation of global supply and value chains. Because in the end, let's face it, we need to pay for this transformation. It is not easy. Don't take it for granted that a factory, a plant, or a supply chain can be just overhauled and changed and transformed in a year. It takes time. And we must be perfectly honest with each other that sometimes we do not have time, or we are a bit pushy that things should go faster. But if anyone would have told me 3 years ago that at this moment in time, we would have seen the ISSB being incorporated, our good friends of the ISSB being incorporated and launching their S1 and S2 standards and pushing it forwards to create this global comprehensive baseline. If you would have told me 3 years ago that in Europe, a set of 12 standards by EFRAG would be published and mandatory as from financial year 2024, looking at the speed of pace with which the IFRS Foundation in the past was able to produce standards, I would not have believed it. And if you would have told me that 2 years ago, 81% of all listed companies in Asia and 78% in Latin America all use GRI standards, and the amount is growing. Didn't we get a question not too long ago, why GRI? Now there is ISSB. Or why GRI? Now there is ESRS. During last events where I had the opportunity to speak, this question was raised not a single time. A year ago, it was on top of everyone's mind. So what we have learned from this is that people see, investors see, society as a whole see that sustainability reporting without a strong impact side, the longer term risk managerial aspects of environmental, social, and governmental challenges makes no sense, because we are dealing with longer term risk management, not only for business, but also for society. And that is why we as GRI are fully committed to the initiatives of the ISSB and of EFRAG in Europe, but above all, are also here to support you, and especially smaller medium enterprises, in being able and enable them to cope with future challenges in this field in such a way that it will yield profits, that it will yield incentives, and not only cost, and should not be something to be afraid of, but to cherish. We are here to help you. Thank you very much for your time.
Thank you very much, Eelco. I think Eelco puts that incredibly diplomatically, because you may be wondering, why are we sitting here having this conversation? We're having this conversation because we're not all on the same page. We're having this conversation because there are various different standards that are still out there, almost competing for space, competing for our attention. And I think, yes, we're on a journey and we're coming together and we're hoping to get there, but you're the audience that we need to speak to, because we need to understand what is it that you need from these reporting standards. And if you understand the difference between them, this will direct exactly the kind of conversation that we need to have today in terms of what do we in Africa need as reporting standards. Now, I've tried to put together, this thing doesn't seem to be responding now, but let's see if it does now. I've tried to put together a little bit of a background of the context of the debate. And what is the debate that our panel is going to be having around? And you have to almost come back, and because I sit here in the academic world, I have to stand back and ask the question, where are we trying to get to? What are we trying to do? Because we could get really, really caught in the weeds here in terms of the different reporting standard criteria. So if you go back to 1997, or you go back to 20 years, it's all about, is there not a more palatable way that we can think about capitalism, where capitalism can be something that is more inclusive of society and its obligations to society? And how then do we create that sort of dialogue around sustainability? So we've got the two competing arguments in terms of how to look at the issue of sustainability. Is it going to be how sustainability affects a company, how the environment, the social problems, the governance problems affect a company, or how the company affects society around those same issues? But it also demands that we rethink economics, and that's been going on parallel to this as well over the last 20 years, that we're no longer thinking of growth in perpetuity. We understand that there are things called planetary boundaries, and if we just keep grow, we hit these boundaries. There's only so much we can do in terms of this evolution. So the idea here was that if we did all of this, if we kind of integrated these social and environmental and governance standards, we would get all this wonderful, great stuff. We would get ESG performance and focus by companies would improve, equity returns would improve, we'd be rewarding the good companies and we'd be punishing the bad companies, and we'd be able to start measuring impact. You know, that whole concept would evolve. And the problem that we face is that none of that really has happened yet. And so you're getting a little bit of pushback, you're getting a lot of pushback, you're getting all sorts of dialogues around how do we actually get to that goal, and what does it require? Is that goal even attainable? And who cares about those things? The bottom line is, this paper is a very good starting point by Ken Pucker. And I think probably, Eelco, if you're listening in, you're probably going to have a heart attack that I'm referencing Ken Pucker. Because Ken Pucker stands up and he says, you know what? This whole sustainability standards just doesn't work. It doesn't do what it was supposed to do. And we've really kind of missed the boat here. And I think we need to understand why he attacks us. And this paper that he wrote comes out in 2021. And it comes out in 2021 in the Harvard Business Review. So it has a tremendous impact on people's sort of assessment as to whether this is even achievable. What I loved about what Eelco said is how much we've achieved in the last couple of years that we never ever imagined we would be able to get to. And so there's a new narrative that's coming out here. And that narrative, potentially, this reporting thing could actually be standing in the way of progress. And I listened to a talk this morning from a bunch of asset management professionals saying, you know what? We're spending so much money and so much time on reporting, we're not focusing on what we should be focusing on, which is investing. So you're talking about something that could very well be standing in the way of progress. The other new narrative here is, has measurement reporting become an end in itself? Is this just big business for these entities that are doing this? And that's why there's so much competition between them to see who's going to win this race. So that's the challenge that we're up against. So a very good point that was raised by Sir Paul Collier, and the reality that we face is capitalism doesn't work on autopilot. So somebody's got to move the dial here. And I think you've all been faced with this. So what is the big issue? Let's get right down to the brass tacks. The issue in all these different reporting standards is, what is material? What is material that the audience needs to know about in terms of the reporting? And when you get down to what is material, that's when you get to the crux of the debate. Because if you look at the different standards here, if you look at the different debates between the ISSB standards and the GRI standards, and then you look up to what we think of as almost the golden standard, the EFRAG, the European standards, it's all about what kind of materiality we're going to look at. Single materiality, what is important to the company. Double materiality, what is important to the society around it. And now let's throw another one out, and that's triple materiality, which we're not even going to touch today, but actually asks the question, how then do we think of the context that a corporate sits in terms of determining what's material and what isn't material? Because if we only do reporting standards without a context, if we only do reporting standards without some sort of target of where we're going or benchmark, then how can we as investors take this information and use it for any kind of long-term transformation? So those are the three debates.
We're here because we recognize the value and the strength of getting useful information out that different report users can use. So the process we're going to follow is I'm going to manage a conversation with the panelists. I'll introduce the panelists to you shortly. There's a second panel that is watching this discussion. And they are coming from some of the leading standards organizations. And they're going to be responding to some of the questions that I raise to this panel and that come up in the discussion and that you raise. So I'll start by asking some questions, lead a conversation with the panelists here. I'll introduce them shortly. And then I'm going to open it to the floor, to all of you in the room. And there might be somebody that's watching the Q&A if there is one online. It's fair to say that we're in particularly interesting times for those of us interested in driving corporate accountability. We're arguably seeing the biggest change in corporate reporting standards since corporate reporting started, arguably with the establishment of the SEC in 1930s. That came out of the Great Depression. And we're facing a similar inflection point at the moment. An inflection point that requires us to have better information to make better decisions. Better information for people that write reports and for companies to make better decisions. Better information for investors to make sure they allocate capital better. better information for government to make sure they make smarter policy, and better information for us as concerned citizens to make sure that we can hold companies and other organizations to account. Now, we're at an inflection point. We're at a really interesting time. Technology and digital is driving change at scale. It's threatening business models. AI has huge opportunity, but great threat. We're seeing social inflection points, rising inequality in certain countries, the rise of populism, Trump and Brexit and Boris Johnson and those interesting things. And we're at an environmental point, inflection point. I mean, you've got to see what's been happening the last few weeks around weather-related events and biodiversity, disrupting supply chains. So companies' business models are being disrupted, and we need information to inform better decisions across the board. So we've got three kind of charismatic species, if you like, in the room in terms of the global reporting standards. The oldest, established in 1996, is the Global Reporting Initiative. Established by one of the organizations was Ceres, an investor group, established to put out there a standard on sustainability disclosure to be equivalent to accounting standards, traditional financial accounting standards. So they're the oldest one. We have more recently the European Sustainability Reporting Standards and what they've come up with in terms of the Corporate Sustainability Reporting Directive, building on an earlier non-financial reporting directive which they had. And then the newcomer in the room, and the one which has huge influence and huge potential impact, is clearly the IFRS. Bringing to the same level to sustainability disclosure what they've done for financial reporting disclosure. So our task today is to do several things, and we'll manage this in this discussion. How do companies and stakeholders navigate these three different standards? How do they work together in practice? What does interoperability mean between these different standards? What are the practical implications for companies producing reports? Which one do we use, and how do we use them, and when do we use them? And how do we navigate this concept of materiality? So just to be very clear, the IFRS, and understandably so, focuses on financial implications. Because if you're going to write a report which is aimed at providers of financial capital or debt, you speak their language, you tell them what impacts the organization, the sustainability risks and opportunities. As the GRI said earlier, they focus on impact materiality, and usually covered in sustainability report. And what the European Union does is to produce reports that inform policymakers. It does both, as does the JSC. So we're going to explore these issues around interoperability, the practical implications, and we have a distinguished panel which represent different stakeholders. So our first panelist is Professor Alex Watson, who I think is the kind of brains on so many areas around reporting in this country. She wears many hats, long-standing professor of accountancy, trained many of the CFOs of clients that I work with, chairman of the board of Coronation, chairperson of the Financial Reporting Investigation Panel, former board member of the GRI, and about to launch the latest Integrated Reporting Award. So huge understanding at different levels around this reporting context. We then have, joining us from Nigeria, Dr. Igazeuma Okoroba. I probably got that wrong, apologies if I have. She's Chief Sustainability Officer at Dangote Cement. And so she's bringing the context of a report writer who's got experience in using the GRI, and in a country which is probably going to be one of the first to adopt the IFRS in Africa, in Nigeria. So useful to reflect on that context. We then have two investors. Darron Scorgie, Head of Responsible Investment at Old Mutual, and Patu Sedzu Mabobo, I knew I'd get this wrong, I'm so sorry. Patu Shedzo Maboho, will that do? Patu Shedzo Maboho. Thank you, getting there. Deputy Chief Investment Officer at Eskom Pension and Provident Fund, so a large asset owner in the investment space. And then lastly, from a regulatory perspective, is Kershia Singh, Head of the Department of Financial Sector Conduct Authority. So different stakeholders to raise and give their views on some of these different challenges. I'm going to start with you, Alex, wearing different hats. So deep experience with the IFRS from a financial accounting perspective. Deep experience with the GRI, having been on their board. Good understanding of and driving integrated reporting in this country, looking at reports, chairman of a board of an investment company. So looking at this from different lengths. Your take on how do you see these standards playing out? How do you see the impacts for companies, and how do you see the interrelationship between these different standards? Just to kick us off.
That's a huge question. And so in South Africa, most listed companies produce an integrated report. And it's been a challenging ride for integrated reporting in that companies started to do them 10, 12 years ago without a lot of guidance. And for me, this is such a positive development that there now is robust guidance that is on how to do a report. Because I look at the 100 largest listed companies' integrated reports, there's some that are good, but most of them, you get a sense of, they've got a marketing team in and they don't have, I'd be interested to know how much investors actually use those reports. And I've always been worried about the fact that you can't really understand where the metrics come from, why they chose that metric, how robust it is, do they have processes in place to make sure that the whole group is doing things the same, is there internal assurance, all those things that make information reliable. So the fact that we're now getting a variety of different standards that are coming at this from different aspects, I think is going to do a huge amount for the quality of reporting generally in South Africa. I also think that in South Africa, we've been a little bit muddled as to who we're reporting and why we're reporting. I'm sure everybody in this room has read the JSE Sustainability Guidance, and there's a lot in that report that talks to me so strongly. But the one thing that I always, when I talk to boards and, boards I'm on about it, first thing I say, and that's the first thing that's in this, as to when you start reporting, think and be clear about what the purpose of this report and who your audience is. And for me, the huge thing about these standards that have come out is that they clearly differentiated on an issue that I think has been muddled in South Africa, and that is that there are different purposes of reporting, and you must report differently when you are, you have different audiences. So at a high level, I think it's exciting. I think it's going to improve integrated reporting hugely, because I'm hoping that reporters will now get a better sense of what financial materiality means, because it's more clearly explained. And I'm hoping that the reports that people put out will be better and more useful for investors, but more importantly, that we will start doing more meaningful sustainability reporting. Because I think that what's been happening is that it's been sort of sucked into integrated reporting, and perhaps hasn't been given the rigor and the quality of the information that it's doing. So I don't know if I've touched on that.
So you would be a strong advocate that, well, let me ask you, that we should make the IFRS reporting standards a listing requirement in this country. Would that help to drive better quality invest information?
I would love to see that, but I would hope that a responsible board would actually be looking at those requirements and applying them. Because if you think of what's in the integrated report, the requirements of that, there's nothing in there that you shouldn't be doing. It's just telling you more detail as to how to do it. They perhaps go a little bit deeper with some of the disclosure requirements, but the fact that you have to have processes, that your governance needs to deal with it, that it should come out at the same time as your financial statements, all of that we should be doing now.
And there'll still be a role for the GRI standards to inform sustainability reports focusing on impact materiality.
Absolutely. I also think that the GRIs, because it's such a robust and widely understood framework of group of standards, that they cover a lot of issues that also have financial materiality that should be in an integrated report. So I think all of these organizations are, as Eelco said, if you'd asked me 2 years ago if we would have been sitting with the suite of standards now out, it's amazing, but it's exciting, and I think they all have a role to play. So, yes.
Okay, I'm going to come back later. We'll ask some more questions of the other panelists about the relationship between the IFRS and the GRI, and why I think one needs impact reporting to inform what impacts the organization, and to raise a concern I think many have had as to why the IFRS seem to be a little less clear on that. But we'll come back to that. Let's go, if we can, to Nigeria, to Igazeuma in Nigeria, about the Chief Sustainability Officer of Dangote Cement. Can you talk us through, you've got experience with GRI disclosure. Can you talk us through, from a corporate reporting perspective, how you see the relationships between these standards playing out in practice, particularly given I understand that Nigeria's stated that they're keen to adopt the IFRS. Is that clear? Over to you.
Hello, everyone, and good afternoon. Hopefully in your part of Africa. So thanks for having me on this call. It's a very important discussion. Perhaps I would just speak to the most commonly used standards, which is of course, the UN SDG. I think people forget that that's also a sustainability reporting framework. And then you have GRI, which the ESRS is integrated with, and there's TCFD, there is CDP, as well as the ISSB. So in terms of how the landscape is going to change, because we see that we have pretty much operated in the voluntary reporting space in Africa. African businesses have done that, but we are on a precipice of mandatory sustainability reporting now because of very specific interests of stakeholders. With the new, of course, GRI is the oldest, as we have seen, but the emerging reporting standards that are coming up now, this is really, I would say it's both a blessing, but it's also a cause of a call for greater attention to ESG and sustainability, and not only for corporations like the ones I work for, but also for small businesses and for NGOs as well. I've had lots of inquiries of asking about capacity building. I happen to be on the adoption readiness working group of the IFRS S1 and S2 in Nigeria. I am on that working group, and we have a lot of feedback on how are we going to integrate this new standard when even reporting sustainability in a standardized manner, I mean, we are lagging. I mean, in terms of compared with South Africa, for instance, there is a gap between standardized sustainability reporting between South Africa and other regions of Africa. And then here you now come with another standard, which the Nigeria government has adopted as which might become regulatory. So that concern is there in the business community, but I've always shared or encouraged businesses to pay attention to this evolving landscape. It's not going to end in a short while. Pay attention to your stakeholders. So we might not focus on the investors' interests alone, but in Africa, we have a broad range of stakeholders, and this is where materiality is really, really important. So businesses at this time really, really need to pay attention to what their stakeholders understand as sustainability, educate them, especially the African market needs to be educated, because if your stakeholders or your shareholders expect you to report in a certain way and your supply chain, your value chain, your all other stakeholders do not know what sorts of data that you need and why you're asking for those sorts of data, it's difficult to adopt new emerging standards, especially as it has to do with scope 3, and you need your supply chain, for instance, to provide this data. So there's a lot of sustainability education that needs to happen to adopt new standards, especially those ones that are requiring disclosures on financial expenditure and investment. So it's a challenge, but I think this is the way Africa needs to go. African businesses need to go if we wish to unlock capital to grow our businesses, embracing the new standards, getting ratings that investors appreciate through rating agencies like the CDP. It exposes you to great opportunities to building your market and to growing as a business. So this is definitely a welcome development, and I think that capacity building and a lot deeper materiality assessment will prepare businesses better.
So can I ask a question about a concern that I've heard several stakeholders raise? If the IFRS standards become mandatory standards in Nigeria, whereas the others aren't, is there the danger that they become the dominant standard and the only standard that is informing what companies are doing in terms of disclosure? And the concern there is, understandably, it focuses on the risk to the organization, because you're aiming to capital markets. You want to make sure they allocate capital wisely. But it doesn't look at the impacts the organization has. Is there the danger that if the IFRS standards are only regulated standards, that we focus then on enterprise value or the entity's prospects without looking at the broader impacts? Is that a concern you think might happen?
Right. So I hope I got all the question right, but I'll respond to the part that I got. The concern about whether other standards will be pushed aside or dumped with the adoption of the IFRS standard as mandatory. Yes?
Yes.
Was that the question? Yes. So that concern truly is there. So GRI is the most commonly used standard presently now, and there are questions about, so what's going to happen to the skills we've gained, the certifications we've gained, and all of the experience we've gained in using the GRI, which was even voluntary. We've had those kinds of concerns. But I from what I know now, the IFRS ISSB 1 and 2 is not yet mandatory. It hasn't been rolled out yet. And this is why we have a working group that would help all these different groups of stakeholders and pay attention to the concerns. But in my experience, what I would put forward is that businesses need to be able to co-integrate all the standards, and there will be no need to set aside a previously used standard for another standard. They are complementary. The materiality assessment helps you to understand your other stakeholders. So the investor focus of the ISB standard even sort of excludes businesses that are not listed on the stock exchange. For my business, we are listed on the stock exchange, and this is an imperative for us. But for businesses that are not listed on the stock exchange, they definitely will continue to go with standards such as the GRI. And if they had need for TCFD on disclosing climate, they have to continue with those standards. So I think we need to look at the requirements of these standards, and you find that they're very common requirements. It's the mode of reporting them, and perhaps the depth of detail and the sector focus that really makes them different. But on the whole, there would be the concern about whether we need to set aside one standard and embrace fully the regulatory one, which is the IFRS ISSB. I think it should be addressed by seeing them all as one and the same, and you're going to probably change templates, you're going to probably expand your stakeholders, work more with the finance teams to see their numbers and match it with what you already know, but definitely not to set aside the previously used standards because they are all complementary.
Darron, you were previously head of the PRI, Principles for Responsible Investment, and now head of responsible investment at Old Mutual. Is my mic working? Can you hear me all right? Yeah? Okay. So a couple of questions. Can you, as an investor who's looking at companies, can you explain to us what is the sustainability information that you're wanting from companies? Are you finding it from companies' reports? Are you getting the right information that you want? And how do you see these different standards helping you to improve the quality of that information, if at all? Darron.
Hi, everybody. Thanks for the question. The sound is a little shoddy, but I think I got most of it. Just with regards to how us as investors are effectively, what are we looking for from an investment decision perspective, and are the frameworks sort of providing that for us? So at Old Mutual, we 100% recognize that long-term systemic issues are affecting investment performance, but also we have that sort of the double materiality lens where we need to also look at how our businesses are affecting the environments in which we operate. So I'm very glad that Dr. Okoroba mentioned there's a multitude of frameworks, not necessarily the ones that have been focused on for today's conversation, but TCFD, for example, which will also focus on single materiality, has been one that our market has widely adopted sort of across the board. I think we have just over 40-45% of JSE listed companies that are reporting on climate metrics in some shape or form, the rest of which are estimated by investors such as ourselves. So do we have enough information to make full-on sustainability, double impact, double materiality decisions? I don't think it's we really all the way there yet. A big part of the sustainability framework drive moving towards interoperability is going to get us there, but it's not quite there yet. We do, as investors, respect the ambition that the frameworks are providing, and it's something that we in ourselves are also looking to work around. But the reality of the matter is, very much to Mr. Van Eerden's opening address, it's incredibly hard work for investors to really understand what's happening within companies, understand the risks and opportunities around sustainability issues, irrespective of whether they're reporting on this information or not. It's just to understand where the materiality lies as a first point of call. So enterprise value has been the focus of all sustainability sort of frameworks and reporting so far. And our market is doing what we can to understand sort of like that the risk management on enterprise value. But that second leg of impact is the next step, and that's where we're working towards at the moment. We are progressing in that space. I think there is a good level of progression that's coming along from the way investors are approaching this conversation. But then to the earlier point is that we do need more consistent data coming from companies, and what in essence where the push is going to be. Does it need to be mandatory? Does it need to be voluntary? Selecting a particular framework, for example. I think all of those conversations in a full-on market-based economy and market-based approach is going to be who benefits, not necessarily who benefits, but how those ecosystems work together to come to find a point of interoperability. I think there's been a lot of noise over the period around sustainability reporting frameworks, but we're getting to a point now of sort of understanding what the progression is. In the South African market, we have the FSCA that has come out to the market and has asked us for our advice on some of their sustainable finance journey. The Prudential Authority has done the same within the insurance industry, has come and asked for advice. So we very much do have a direction of travel as to where these frameworks are going to go, at very least in the South African market. And the ambition is admirable. We just need to 100% recognize that the working environment to actually make a solid ESG decision is still quite difficult. But the progression is there, and us as investors, we have at very least we have a view, and this view is adding materiality to our conversations.
The second round of questions, the first point you made right at the beginning about the importance of understanding the impact the organization has and not just looking at enterprise value, because that's not, to be honest, my experience with many investors. Understandably, they're focusing largely on enterprise value to make sure that their money is, should I invest my money in this organization? Is it a good long-term bet? And the IFRS is addressing exactly that issue. I'm gonna come to you, Patushedzwa. Working as you are at Eskom Pension and Provident Fund, one of the largest pension funds by asset value in the country, you're a signatory to the PRI, you subscribe to CRISA, you've got a stated commitment to incorporate ESG issues into your investment analysis and decision-making. So the same types of questions I'd ask you, are you getting the information that you want from companies to make informed investment decisions? Will these standards help? And if so, which standards are going to be helpful?
So first of all, you may notice that I'm taking a lot of notes because there's so much going on in this space, standards and reporting, and a lot of this stuff is still quite new to some of us. So, but I appreciate that we're all trying to move in the same direction, right? So we are a pension fund, as you said. So there are a number of ways of looking at this. First of all, we're an asset owner. So some of our money is managed externally. So we allocate it to asset managers and they manage it on our behalf. Some of it is managed internally. So the different ways we look at this as an asset manager and as an asset owner. Are we getting the information we need? Look, I put it into two categories. I'd say if you think about the social stuff, transformation, BEE, gender equality, I think we're finding a lot of that stuff in the financial statements. Part of it is because ourselves and a lot of other people, regulators as well, other asset owners have been making a lot of noise about this over time. So last 10, 20 years, we have spoken a lot about transformation, for example. If you think about the environment, which is, I suppose, flavor of the month now, everyone wants to talk about climate change. We're getting there, right? We're getting there. This is what Pan is referring to. I think what we've been doing up until this point is what you may describe as a low intensity boxing match, right? So we go to AGMs and we say we don't like this, or we vote against that, and they give us something else. So it's both sides still trying to find each other. But I think the point she makes is an important one, because I think a lot of it has to come from ourselves as shareholders and the regulators. We need to give the guys guidance out there on what we're looking for, right? So it's fine to be asking whether there's enough information in the financial statements, but it's not entirely fair to expect that they would know what we are looking for. And so when you subscribe or when you join the Net Zero Asset Owners Alliance, for example, you're taking a position and you're saying anyone who has my capital would have to behave a certain way, right? So we've taken a position, we're giving them guidance. And so that helps a lot. So I think that's the first part, which is what I would consider to be risk management on the sustainability side. On the social and environment, I think those are things where you're saying, if you're not doing them properly, this may work against you somewhere along the line. So if you're a mining company and you're not rehabilitating the communities where you're mining, in a few years' time, maybe you don't have clean water, or you don't have any sort of water that you need. If you're not looking after the communities, or rather, if you look after the communities, you generally expect that you're safe from the community in case there's looting and things like that, and vice versa. If you're not looking after them, you can't expect them to look after you. But the other side of sustainability, Jonathon, is what most people are discussing here, which is sustainability of a company when you look at cash flows, for example, and profits and long-term value. And is there enough disclosure on that one? Personally, I think there's probably enough. I think we could do more. I think we could standardize it a bit more. The truth of the matter is that it's always going to need interpretation, right? So sitting next to an accountant, the truth is that even if we came up with new standards that everybody needs to adhere to, the accountants would just, they get very creative, you know that. So, it's like that. So we come up with something, they'll get creative and do it a different way. So I think that's on the listed side. On the unlisted side, it's slightly different because, first of all, the companies are smaller, much smaller than the company she chairs. 2 or 3 billion rand enterprise value. So they're a lot more focused on survival and getting growth. So they'll tell you about, we don't have the resources to do a lot of the reporting that you guys need. But if you look at it from the other side, you tend to be a bigger shareholder in an unlisted company than you would be in a listed company. So it's a lot easier to throw your weight around, I suppose. So we would say we need women on the board. We need Black people managing the company. And equally, we can put those standards in place for everything else, like we're trying to do with the Net Zero Asset Owners Alliance, for example. But similarly to the listed side, I think that there's a lot going on. I don't really want to blame the one side or the other side. I think that everybody has a role to play. And as I said, I think between ourselves and the regulators, there's a lot more we need to do to give direction what we need going forward. So the standards would definitely help. They've suggested a few things. But maybe I'll just let her speak for herself. Yeah.
Let's go to Kashia. You're with the FSCA. Can you explain what exactly they do, and in particular the relationship with the JSE? A lot of questions I'm getting from companies that I work with is, are we going to have the mandatory IFRS standards? And I guess that question is still up in the air. Who's going to make that decision? You probably can't say where the decision might be at, but what's that like? So what is the thinking around that issue? Perhaps we can start off, explaining your role on that, and then I'll have a follow-up question.
No problem. Thank you so much. So I think the financial, let me start with an overview of what the Financial Sector Conduct Authority does. We are part of a Twin Peaks regulatory architecture in South Africa. which means we look after fair customer treatment and market integrity regulation. So that's typical capital market regulation. Our sister regulator is the Prudential Authority, and they consider financial safety and soundness regulation of financial institutions, and particularly from an overall financial stability perspective, they also work very closely with the Reserve Bank. So I feel like we are sitting here because we have a lot of power as a regulator, and with great power comes great responsibility, to quote a Spider-Man movie. So in terms of a relationship with the JSE, let's remind ourselves the JSE is not the only market infrastructure in South Africa. We are regulators of all market infrastructures in South Africa. We do have a SRO model, which means that there is quite a lot of delegated authority to the JSE, but we work in very close conjunction when it comes to things like listing requirements and disclosure requirements, which I think is very pertinent to the discussion that we're having today. In terms of direction of travel, number one, the point that I want to make is, and I think it's the point Anne made at the beginning, I don't think what we're discussing here should be seen as us kind of saving the world and solving all the world's problems. I think about it sometimes, I'm sure we've all come across going out and at a restaurant, ordering a drink and getting a paper straw. And you think, look, I know that this is supposed to be contributing to the greater good, but I'm drinking with this paper straw that's dissolving in my drink. And I know that there are people taking private jet trips for leisure purposes, But that doesn't mean that the work that we're doing is not necessary and not important. So I just want, when we speak about sustainability reporting and people bringing in kind of their marketing and PR teams, sure, maybe there's an element of that, but I think it's really, really encouraging that these conversations are happening. I think colleagues have spoken before me about the speed at which things like the ISSB standards come out, the TCFD guidance. And I think what's really illustrative from these, the climate response in particular, there's a really scary impetus to responding to climate change. And so we've got this 2050 timeline. We've got the net zero commitments that companies are making. And I think that lends itself to reporting that is able to be compared, consistent, and assured against. I think it gets a lot trickier when we start moving into other sustainability considerations on the social side, even beyond climate on the environment side. And so how I would see the ISSB standards, for example, in relation to the GRI standards is a necessary component, but it shouldn't be seen as the be-all and end-all or the end of the story. I think it provides a really, really useful benchmark, global guideline. I think, from what I've read, there's a lot of reassurance that companies that have been following GRI should find the ISSB standards relatively easy to comply with. And that, I think, points us in a good direction to say that this could be something that we build on with the aim of having information that is credible, that is consistent, and that we can have assurance against as well. So where there is creative accounting, that we do also have independent third-party verifiers to let you know that this information is something you can rely on. So I'd see it as part of an ongoing journey. I understand that, the question is, are we moving fast enough? And I guess that is something that is still to be considered.
Okay, thanks. I'm going to raise, and I'll come to you, Alex. I raise a quote that comes from the current head of the GSSB. So that's the standards-making part of the GRI, Carol Adams, an academic. And she said the following: "It makes no sense for a legislator to require risk reporting, so risk to the organization, without also requiring GRI's multi-stakeholder impact reporting. The European Union knows this. Perhaps others will work it out. Who wants to be on the wrong side of history?" So the point there is, if we're going to require disclosure standards, She's arguing that we make sure we don't only require the IFRS standards, but we also require the GRI standards. I want to come to you, Alex, as somebody that was on the board of the GRI, and to speak to the concern that many in the sustainability field have. And that's that while we understand that the IFRS has a particular role, and that while you and I have both been outspoken that the role of the integrated report is to speak directly to providers of financial capital, because if I'm going to make the case that I'm a good long-term bet as reporting organization, so you're speaking to them, and the IFRS is doing the same. So you want to get better allocation of financial capital, and that makes sense. But is there not the concern that that the IFRS might become the dominant standard, that the GRI falls by the wayside? And do we not really need to understand the impact the organization has to have a better understanding of the impact on the organization? And the IFRS doesn't draw that link. And many have pointed out, and I've seen this myself, that the IFRS, when it speaks about interoperability, mentions the SEC and the European Union, but the GRI kind of disappears. So is that a concern that you're seeing? What are your views on this kind of dynamic that's playing out?
All right, I mean, I think firstly, to put it in a bit of context, South African companies at the moment don't have to do GRI or sustainability reports. And of the top 100 companies, 70 plus do produce a sustainability report and obviously see value in that. So, you know, that suggests that people see a value, they've done it before, and I can't see why any of this would change that. But having said that, you know, to do a report that properly does financial materiality, you do have to understand what your impacts are. You know, so for any risk committee that is looking to make a long-term assessment of the risks that are facing that organization, they need to fully understand their impacts. Because even though we see them as external impacts now, I can't really think of many external impacts that don't have the potential to become internal impacts in time.
So, but that raised the big question: is timeframes. So, and the problem. And let's come to the two investors. So, if I can, and then I want to get a sense: how many people have burning questions in the room? If you've got a burning question, raise your hand, because I do want to give a chance. Any burning questions yet? Just so I can get a sense of temperature. There's one or two. Okay, I'll come to those questions. Let me come to the investors. So the two of you here on this question of time, and I can give a classic example. So let's take food. There's very high margins, financial margins, benefits in having highly processed foods or sugared water, Coca-Cola. That has a negative impact on society. Huge impact on GDP. It makes people ill, and it's malnutrition. Malnutrition is bad, stunting on children, blah, blah, blah. High financial margin, but it's an impact, a negative impact that's dissipated across society at large. Is that likely to be a financial return on the organization? No, it gets shared. It gets shared out there. Is it going to impact on your margins? Unlikely. So the investors are saying, well, actually, I can see the benefit in you externalizing those costs. The time frame is much further down the track. So it's that tragedy of the horizons that Mark Carney speaks to. People are, and I've seen this, are slightly cautious about the pace of change that investors are driving. I'll raise one more example, and then I want you to push back and make the case to me that you're going to drive the change that's needed. Back in 2006, when I was working with Sasol, I engaged a group of investors in this country, and I asked them, what are the big sustainability issues impacting Sasol? Only one investor in this country mentioned climate change. Can you believe it? When you have the highest point source of emissions on the planet from Sasol, not a single one investor in this country. All the international investors mentioned climate change. So then I realized the investors in this country just don't get that climate change is an issue. So Incite brought the CDP here to raise investor awareness. My concern is that investors are still largely too short-term, focusing on enterprise value. And if the IFRS becomes the dominant standard, it plays into that narrative. Would either of the investors like to push back on that?
Okay, so I have a few things to say, Jonathan. Firstly, on the Sasol thing, I was not one of the people in the room. So, I doubt that any of the investors would have been thinking climate change is not a problem. I think the way we think about problems is what's more immediate or what is needing to be attended to right now. Okay, so maybe. So it's true that if you talk to a pension fund in the Netherlands, for example, they would consider climate change a more immediate problem than a pension fund maybe in South Africa. Maybe let's exclude Eskom pension fund out of this because of the country we live in, right? It's not that we're short-term in our thinking. We just recognize that there may be other issues that we need to be attending to before we get to that. But we can do all of those things in parallel. You can chew and walk at the same time, right? But if you needed to eat and you were dying of hunger, you'd go for the food before you start walking, right? And then you do both. So I think we just need to think about it like that. We're never going to get to everything at the same time. Are we short-term in nature? My view is this is not an investor's view. I think this is just human nature, right? If we're honest as people, we're always going to think about what is it that's going to bring me the most benefit or joy, either myself or my family, and then my friends and my community in that order, right? But I suppose as humans, we're not always honest. So that's why we need regulators to step in and tell us certain things you cannot do, because I could make a decision today that makes me and my organization look good for the next year, 3 years, and maybe even 5 years. But 5 years from now, I won't be there, right? And it's difficult for me to consistently think about making decisions in 20 years and not think about what I get measured on at the end of the year or at the end of 3 years. We're human and we need to own that. That's why we need the police and the regulators to tell us this is not right, you should not do this, do it a different way. So I'd look at it like that. Yeah, I think that's my view on that, John.
Okay, well, let me ask you, Darron, what's long-term for you at Old Mutual in making your investment decisions?
What I want to do is, I acknowledge the question, looking at our long-term view for Old Mutual. But what I want to do is also just kind of add a little to some of the sentiment that I heard very sporadically in the build-up to the question. There was a book written in the 80s about finite versus infinite games, right? Finite players of a game tries to win, whereas an infinite player of a game is just trying to keep the game going. I think what happens within sort of like the global business environment is that we have some players that are playing a finite game that are just outright trying to win, and we have some players that are playing the infinite game, trying to keep the game going. Ourselves as an asset owner and an insurance company, we are in the infinite game space. We do look further out. We recognize that for us to manage 30-year pension funds, for example, we need to have a long-term horizon view. For us to take risk of a industry, we need to have a long-term view, but we also do need to have a risk management view in this process. So with us in the investment team, we constantly have these conversations with our pension fund clients, and just generally within the insurance industry about the systemic risks that are presenting to us in the business of Old Mutual, but also within our investment portfolios. There was a point made around the short-termism of the industry. I don't disagree with that, but I would say that the industry is looking up. I think they are looking a little bit more further into their futures, and scenario planning is becoming a more important consideration in making certain investment decisions, especially with regards to climate. Both Fatatwa and Old Mutual, well, EPBF and Old Mutual, have made net zero commitments, which is that level of impact that you're referring to. And we are looking down the road. We're looking at how do we decarbonize our portfolios. That's a direct impact measure. Within where we have space to do so in our unlisted space, we are looking at how do we contribute towards economic growth and decent jobs. So we invest within an impact fund focus on education, focuses on schooling, focuses on affordable housing. It focuses on retirement fund as well. Retirement housing, which is also a big need, a systemic need that we see within our markets. So the view of short-term investment profits, by all means, the difference between the asset owner view and the investment management view is changing. Asset owners do have a responsibility to kind of throw the line a little bit further forward, and investment managers have to take the mandate from that and adapt and apply. As asset managers such as EPPF, ourselves at Old Mutual, and the other insurers do start making these long-term commitments like a net zero, we will start seeing this change. I also want to say, when we have these changes, these are big systemic changes. There's generally two approaches for a systemic change. You could do the Pied Piper approach, in terms of there's a huge incentive, it's leading from the front, and everybody kind of follows the incentive. Or you have the inverse, which is the shepherding approach, where you have effectively a dog clamping at the sheep's heels as it moves forward. And that's that leg of voluntary versus mandatory disclosures. But whichever way you're going, whether you're using the Pied Piper approach or the herding sheep approach, you still need the guardrails. You still need everybody to be moving in the very same way, rather than deviating. And these frameworks are becoming those guardrails. The reporting standards are becoming those guardrails. And an earlier point in the very bad sound that we heard is around how these how the skills and the capacities being built within these various frameworks could be lost if one becomes mandatory over the other. I think we have to applaud our regulators in this space. Our regulators haven't leaned too heavily on one framework versus another. Our regulators have taken a very holistic approach to this, and the JSE as well, which is a regulator of sorts, has included double materiality in its approach. It has given a wide overview in terms of its guidelines as to how it goes. Again, I mentioned this, the FSCA with their Sustainable Finance Roadmap are taking a holistic view. The Prudential Authority, as mentioned earlier as well, are taking this holistic view. So I think the risk of one framework stepping up over another, there are enough market responses that are determining which frameworks we want to use. We started with TCFD because we had a climate imperative. And as we move further, GRI probably has the bigger and the more instrumental focus on sustainability issues at the moment. IFRS S1 and S2 just aren't there yet. So there's as an investor playing an infinite game that knows that they have to be there for 30 years, 40 years into the future, we recognize the systemic risks are real and they do affect our enterprise value. But not only that, it does also affect our ability to maintain customers and society in which we operate and keep our social license. So as those systemic issues do ramp up, market response would be to from a demand perspective, will pull closer towards GRI until.
Thank you. I hope you can hear me. I'm looking at the regulatory perspective. I don't know if the JSE is in the room, but what I seem to be hearing is that we need to look at kind of both of those two standards, the IFRS and the GRI, which is kind of the approach, well, exactly the approach the European Union has taken, and it is the approach the JSE took in its disclosure guidance, the double materiality perspective. I do share a concern that actually in many of my clients, the GRI might well play second fiddle to the IFRS if the IFRS becomes mandated. And I do think that's a worry. And I do think it'll undermine the quality of the information. Two quick questions of the two panelists before I open to the floor. Igazeuma, as a reporter, are you getting better quality engagement from investors in Nigeria on ESG issues? Are they rising to the challenge? Are they seeing ESG as a material issue? Or is it something that is still off to the side? Very briefly.
What we have seen over the years is the focus of investors for us hasn't changed so much because we always included other stakeholder groups in our materiality process. But with the Nigeria government considering the adoption of the IFRS standards, I think there's going to be sort of an inclusion or greater inclusion of local investors. And I think that's a good thing because the focus on foreign investors is sort of excludes the shareholders or local shareholders, and for us it's beyond providing good returns on investments. There's this idea of Afri capitalism where we should be able to drive or increase capital or investment that can be gotten locally. So while perhaps foreign investor expectations may not have changed, they want to see your commitment to climate change, they want to see your performance on other ESG factors. I haven't seen that shift very much. The local investors and shareholders, as a matter of fact, now need to be more involved in monitoring company performances. And I like to call them investors and not just the shareholders that are more focused on dividends. They are also investors. So I think this is where we really need to find value-added growth, educate our local investors more, and expand the scope of reporting disclosures that we share with investors to include the concerns of local investors and foreign investors. But so far, I haven't seen a major shift in the interest and expectations of our investors. We assess this very frequently through materiality assessment, and I haven't seen a dramatic shift, no.
And that I would suggest is a cause for concern, because I think we need to see greater levels of engagement from investors on ESG issues. And if anything, there's some degree of pushback. It's become politicized. There's this concerns around greenwash. There's this mindless idea that it's woke coming from the Republican Party and others. I'm kind of concerned that anything we're kind of going backwards rather than forwards. And I still, in many of my engagements with companies, I'm not seeing the level of prod that I would want to see from investors that are forward-thinking and that are long-term around sustainability issues.
I think we're all very proud as South Africans that the JSE came out with the idea of double materiality, and we thought that was the right thing. But now you've got IOSCO ascribing to ISSB standards and saying that's what we're going to go with. And now remember that the JSE is a member of IOSCO. So the question is, I go back to a point that I raised in the beginning. A lot of the pushback is coming from people saying it's just too much, all this reporting. It's just too much of a financial demand on us, and we don't have the skill sets to do it all. So the question that we asked Kirsha earlier is, who calls the shots? Who makes the final decision? Does the JSE say, well, listen, we're going to get a lot more people listing if we just kind of reduce the amount of reporting standards, and we go with that, which creates a problem for you because you don't have that two different sites on the materiality? Or do you step in here, assuming you're on one side or the other, or assuming that you see that there's a need across the board?
We would step in. As I've said, we wield a great amount of responsibility, and we have to very carefully consider what that responsibility means. I just want to caveat as well, we're a financial sector and capital markets regulator, which means our sphere of influence is the listed environment and financial institutions. We certainly don't want to be creating unlevel playing fields between listed and unlisted environments, which could drive perverse outcomes in terms of delisting, et cetera, et cetera. But we also need to make sure that we remain globally relevant. And so we are also looking at what capital markets regulators in other jurisdictions are requiring. And we can't ignore that IOSCO has endorsed the ISSB standards. However, I do think, coming from South Africa, not just in terms of the JSE disclosure, but things like the King Code, our BBBE Act, our Labour and Labour Relations and Employment Equity Acts. I don't think that we're coming from a base in South Africa where the conversation would end at the single materiality. And this is why, for me, I see this as a stepping stone almost. Jonathon, you actually did share, a diagram of thinking about single materiality and double and even going into triple materiality. And they're all parts of a bigger picture. I think it wouldn't be a great outcome if we see this positive development of the ISSB standard as taking away from rather than adding to a broader sustainability and impact landscape. And I would certainly hope that that's not what happens, that, resources are focused on what becomes, a focus on single materiality, should it become a mandatory standard to the detriment of broader impact and sustainability reporting.
Jonathon, I think it's important that we just, because we're going to be talking to the European EFRAG people in the next section, that we move a little bit further down the road and explain what this triple materiality thing is. And that is, if you don't have a regulator also setting targets, saying this is where we need to get to, that's really the context that we were talking about here. So if you're doing...
Which regulator is that? Because
Exactly.
we're a financial sector
Exactly.
regulator. We're not here to set targets on net zero and, when it comes to the sustabbability conversation as well.
Good point.
Yeah.
Excellent point.
Yeah.
So,
Okay, we'll have a chance to raise that of the European Union. I'm conscious of time. We started late, but I only saw one question from the back. Is it still there? And I see another question. Let's get both of those questions. Are we happy to, because we started late, can I extend into the tea break briefly? So the two questions, please, if you can say your name and brief comment, please.
Your question in relation to, do boards have the knowledge? My experience of the boards that I'm on, we have had so much sustainability training in the last year or so, which has been fantastic. And that's why I think these standards, another reason why I think these standards are so important, because their boards are now having to talk about them. Boards have to sign off on annual reports, and in my experience, boards take the preparation of what's in an annual report or an integrated report quite seriously. And if they're now going to have to disclose, what their risk process is, how broad their thinking is of what the risks and opportunities are from sustainability-related issues, I think that the boards are not there yet, but I think there's an understanding that there's work to be done. So I do think that my experience of boards are on the right track, but there is still work to be done. Just to pick up on your point about the broadness of disclosure, my feeling from looking at annual reports and sitting on boards is that there's not enough attention paid to what is really material to that organization. You see all the companies giving much the same sort of disclosure without a sense of, okay, if you're a mining company, your labor and your community and your environment's important. In the higher education, your carbon emissions is probably not the most important factor. I'm not saying it's unimportant, but it's not the most material factor of the impacts that you would be having. So, I think that it's very, and I don't want to blame regulators here, but I'm sort of looking at this from an IFRS perspective. A lot of the regulators look at and sort of give pushback on bad disclosure without understanding what is really material to that particular organization. And I think that this concept of what is material is not just, is it impact material or is it financially material? It's in the context of your business model. What is the most important factor that would impact the resilience, the ability of your business model to continue going forward? And if I could just make a sort of comment about where I think that reporting hasn't been done well in South Africa is on talking about the link between what the impacts are and how they affect the resilience of an organization. So, that's why I think both of these standards are so important, because you've got an impact one, which is what the GRI is requiring us to do. And then you've got one that focuses on financial materiality, where you've got to take those impacts and talk about how it affects your business model, your availability of the resources and relationships that you will need to go forward. And that, in a sense, is a little bit of where the IFRS sustainability standards are going.
I might take issue a little bit with that last point, but not now, maybe in the next session. Let's get the two investors very briefly. Do you give a damn about integrated reports? Are they useful? Do you look at this thing about 5 capitals and all the stuff which people are kind of filling in? Does it meet your needs? Or the 6 capitals, sorry. Sorry, I'm looking at both of you. Yeah, why don't you start, because you're right here.
Thank you. Short answer is we do care about integrated reports, Michael. There's a lot of information in there. They do not necessarily cover the same things. So a while back, I covered an insurer, for example, and I could just look at the integrated report without necessarily interacting with management and get a lot of information from that report. Now, because they don't all report the same things, that's why we need standardization, I suppose, to an extent. But yeah, there's a lot of information in there. And the reason we would ask as many questions as we do is also because we're not trying to get to the same answers. So some of us may be trying to understand if the company is participating in its community, for example. As an example, are they doing what they need to do as a member of the community? Some of us are simply trying to be investors and understand if there's value in the company. So it's not always the same things that we're looking for when we ask questions. It's always a good idea to speak to management when you can, but a lot of those questions could be answered in the integrated report if everyone follows what we're looking for. So the short answer is yes, we do care about integrated reports, Michael. Thanks.
We're going to have to keep this very, very short response, Darron, from your perspective. Very brief, please.
There are two things to care about. There's one, do we care about the ESG agenda, sustainability risks agenda? And secondly, do we care about the integrated reports? The first part is the level of care, or where the driver for that care comes from, is in client demand. Our pension fund beneficiaries are asking for more information around sustainability risks. So that's a big pull or big demand factor for us to care about this. We also have, to the very point of this conversation, we are seeing global regulation stepping up into this environment. So there's another aspect of care over there. And as I mentioned earlier, as an infinite player, we want to keep the game going. We want to stay in business for as long as possible. We do have 30-year horizons. So from that aspect, we have to care. The second part is, do we care about the integrated report side of the conversation? Very much to the response from EVPF, different organizations have different approaches to their sustainability reporting in general. Some of them are doing phenomenal work where they are actually going into their risks and opportunities, and they're detailing it in immaculate detail to say, this is where we're seeing the materiality on our business. This is what we think is going to be a challenge, and this is how we want to mitigate and address that. A big example of this is, Sasol, despite what people may feel about their report or their transition, but effectively they have acknowledged their risks. They have identified additional revenue streams in a greener environment, and they're steering themselves in that way. As investors, we see them focusing on their opportunities, so we effectively want to track that progress over time. As we get more detailed, that's one thing. But there are some players or some market reports that they don't know, and they haven't done sufficient sustainability strategy work for them to really know about. And those are the ones that will say a climate physical risk is one where it rains and it may affect our business. And it's not material to anybody. It means nothing to nobody. It's a 60-page document that says nothing. And then those are the ones where our investors go engage and solicit the information that we need to determine financial materiality. And then secondly, like I said, because we are a long-term player, when we're looking at avoiding negative impact or promoting positive impact, we care to see where the opportunities are and where we can invest and follow them and follow those invested companies through. Thanks.
Perfect, thanks. So I hope the questions that were raised have been answered. I'm conscious we've gone over time. I'm looking to
I think we've pretty much eliminated tea.
Well, yes, that might not be to everyone's satisfaction. The aim now is to have a panel with representatives from the GRI and from EFRAG and from local regulators to kind of reflect on what came out of this discussion. They've had a chance to watch this. They're going to be sharing their views on issues and questions that were raised. So can we have a very short break? Is that all right? And then the discussion will continue with a different panel. But if we can say thank you to the panel that was here. I'm sorry we ran over time. Discussion will carry on. Thank you.